Welcome to the deep dive. Today we're digging into something pretty specific but hugely important, how finance gets structured.
Mm-hmm.
Our mission is to really unpack the source material on launching a venture capital fund in Luxembourg. We want to understand the actual structures, the market advantages that make it such a powerhouse.
And it really starts with the core fact, doesn't it?
Yeah.
For you, the listener, the big takeaway up front is that Luxembourg it's cemented itself as the #1 European hub for investment funds.
Right.
That reputation for international financial services, it's outstanding. It's really where global capital tends to gather.
Okay, #1 sounds good, but what's really behind that? The sources talk about stability, political and economic, which, okay, that makes sense as a baseline.
Stability's table stakes.
But what's the unique draw? What makes fund managers choose Luxembourg over, say, somewhere else?
I think the sources point to this commitment, this institutional focus on providing options. They offer what's genuinely called an unrivaled range of investment fund solutions.
An unrivaled range.
Yeah, think of it less like a rigid system and more like a, really well-stocked financial toolkit. They were already big in banking and traditional funds, right?
Mm-hmm.
So they built this legal and regulatory setup that people just, recognize internationally.
And that recognition, it's not just talk. The sources say Luxembourg funds are managed or administered in something like 70 countries, globally recognized.
Exactly. That reach is huge.
Yeah.
It's critical if you're trying to pull in capital from outside the EU, for example.
Okay, so that existing strength, stability, global recognition, banking expertise that laid the groundwork.
Precisely. It wasn't a huge leap then for Luxembourg to become a major center for the riskier stuff, private equity and venture capital. They weren't building from scratch.
Right.
They were adapting this already sophisticated system, adding what the sources call these winning features, specifically for PE and VC sponsors.
And the market noticed, apparently. We've seen real growth in PE and VC there. Investors are clearly looking for that kind of quality structuring.
Yeah, and the crucial part is they haven't just sat back. Luxembourg keeps, modernizing. They keep offering new structures that actually match what sponsors and GPs need right now.
That commitment to refreshing the toolkit, as you put it.
That's what keeps the momentum going, that proactive stance.
Okay, that brings us nicely to the main event then, the actual vehicles. Yeah. If a manager wants that sort of institutional comfort, the full regulatory oversight, where do they begin?
We should probably start with the regulated options under the CSSF.
Yeah, the Commission de Surveillance du Secteur Financier, the main regulator.
So the first one.
We'd look at the Specialized Investment Fund, the STIF. This is really the workhorse, the standard structure for alternative investments there.
Why standard? What makes it the go-to?
Well, it offers a pretty broad scope for investment, but crucially, it's authorized and supervised directly by the CSSF.
Ah, okay. So that direct CSSF oversight provides that layer of comfort, especially for big institutional investors, pension funds maybe. Absolutely. That regulatory stamp matters to them. The SIF can hold all sorts of assets, real estate, hedge funds, PE, VC. The main constraint is just adhering to risk diversification rules.
And who can invest? Is it for everyone?
No, it's specifically reserved for qualified investors. So, investors who meet certain thresholds or have proven financial expertise.
Got it. And structurally, what are the advantages?
Well, compared to the really formal retail funds, the UCIs, the SIF has lighter regulations.
Yeah.
Setup is relatively quick. And importantly, no levies or withholding tax on distributions. That's a nice administrative and tax plus.
Okay, so SIF is the versatile regulated standard. What if you're laser focused just on PE or VC?
Then you look at the SIC, the Investment Company and Risk Capital. This one is purpose-built.
Purpose-built how?
Its rules actually require it to invest in risk capital. It's written into its DNA, basically, unlike the SIF, which can be more diversified.
So its whole reason for existing is PE-VC deals.
Pretty much. The goal is collecting funds from well-informed investors, similar standard to the SIF, specifically to help, finance or turn around the companies they acquire.
And why choose SICAR over SIF if you are doing PE?
The sources mention it offers a lot of corporate flexibility. So more freedom in how you structure things, governance, that sort of stuff. Plus, it comes with a very favorable tax treatment designed specifically for risk capital investments. It's kind of the boutique choice for pure-play PE/VC managers.
Okay, so SIF for regulated diversification, SICAR for regulated focused risk capital. But, in VC, speed is often everything. Waiting months for CSSF approval, that could kill a deal.
Exactly, and that's where the market pushed and Luxembourg responded. This leads us to probably the biggest innovation in recent years, the RAF, the Reserved Alternative Investment Fund.
RAF. Okay, the sources call it a hybrid, mixing SIF and SICAR features. But what's the killer difference, the aha moment?
The regulation, or rather, the lack of direct CSSF regulation for the fund itself.
Wait, how does that work? No CSSF supervision.
Well, the fund vehicle itself is not authorized or supervised by the CSSF. That's the fundamental shift. It takes the regulator out of the initial approval loop for the fund.
Hold on. If there's no CSSF sign-off on the fund, where's the oversight? And how is that really faster? Don't you just swap CSSF approval for, I don't know, needing an approved manager or something? Isn't that just trading one bottleneck for another?
That's a really good question. The speed advantage isn't about avoiding regulation altogether. It's about skipping that initial, potentially multi-month CSSF application process for the fund structure.
The
Burden
big
shift
yes.
to the manager. A RAIF must appoint a fully authorized alternative investment fund manager, an AIFM.
Okay. So the AIFM is the entity that's already regulated by the CSSF.
Precisely. The AIFM takes on all the ongoing compliance, the reporting, the supervision of the fund's activities. The AIFM is the regulated gatekeeper, not the fund itself.
So if you're a fund house and you already have an authorized AIFM,
Then you can launch RAIF potentially in weeks, not months. It dramatically cuts down the time to market. It's much easier to set up quickly.
assuming you're targeting the right investors?
Yes, critically, it's still restricted to well-informed and professional investors. But yeah, for speed, it's a game changer.
So the RAIS really embodies that regulatory evolution we talked about, responding to the market's need for speed while still maintaining oversight through the manager. And it can still have multiple compartments, right, for diversification.
Yes, it retains that flexibility. It's a very popular structure now.
But we can go even further, right? More flexibility, maybe less regulation still.
Absolutely. If maximum structural flexibility and tax efficiency are the goals, especially for managers dealing with, say, specific types of non-EU investors, they often look beyond even the RAIF.
And that takes us into the world of partnerships, unregulated partnerships.
Exactly. Hugely popular in PE and VC globally, and Luxembourg has its own versions drawing from common law principles. The main ones are the SCS, Limited Partnership, and the SCSp, the Specialized Limited Partnership.
Okay, SCS and SCSp. Why are these specific partnership forms so attractive?
It really boils down to one crucial feature, especially for international LPs: tax transparency.
Tax transparency. Tell us why that's such a big deal for, let's say, a manager trying to raise money from U.S. endowments or Middle Eastern sovereign wealth funds.
Because it massively simplifies things across borders. With a tax-transparent partnership, the fund itself doesn't pay corporate income tax.
Okay.
Instead, the profits, the losses, they just flow through directly to the end investors. Those investors then deal with the tax implications in their own home country, under their own rules.
Right, so it helps avoid potential double taxation. But maybe even more importantly, it helps certain investors avoid really complex foreign reporting headaches, like for U.S. tax exempts dealing with things like PFIC rules.
That's often the core advantage.
Mm-hmm.
Passive foreign investment company rules, or ECI, effectively connected income, these can be major deterrents for U.S. tax-exempt institutions like university endowments or foundations.
So using an SCSP can basically remove that friction, making it much easier for them to invest.
Yes, it streamlines things considerably for those specific, very large pools of capital. It removes barriers that might otherwise just stop them investing in a European fund altogether. It offers huge efficiency for certain key investor types.
It's really clear Luxembourg offers this whole spectrum of tools just domestically, but connecting it outwards, Luxembourg isn't just an island, right? It's positioning itself as a gateway to Europe.
Definitely. And that brings in another layer, the European layer, specifically the EUVECA designation, the European Venture Capital Fund.
EUVECA. Okay, how does that fit in with the SIFs and RAIFs and partnerships we just discussed?
Think of it as a companion label, linked to the broader AIFMD framework, the Alternative Investment Fund Managers Directive.
And what does this EUVECA label do for a Luxembourg-based manager?
Its main purpose is to make it easier to set up and, crucially, market VC funds across the entire EU. So your SIF or RAIIs might be the Luxembourg structure, but the EUVECA label gives it wings, essentially.
The passporting concept.
Exactly. The EUVECA rules allow certain AIFMs, specifically smaller sub-threshold managers who aren't fully under the main AIFMD rules, to market their qualifying VC fund across the whole European Economic area, the EEA, on a single passport.
Ah, so it helps smaller, potentially newer VC managers access the entire European market from Luxembourg.
Yes, it leverages that local setup into continent-wide distribution. The sources call it a considerable opportunity for managers based there or thinking about setting up there.
And it's not just about the legal structures on paper, is it? The source mentioned Luxembourg is actively building the soft infrastructure, too. Incubators, conferences.
Yes, that's key. They're fostering the whole ecosystem. You need the legal tools, but you also need the network, the events, the support services that make a financial center actually buzz. It's the combination.
Right, the hard law and the soft infrastructure working together.
That synthesis is what underpins its continued leadership, I think.
Okay, so let's try to wrap this up for someone considering Luxembourg. We've gone through the whole range. The CSSF supervised SIF for that institutional comfort. The purpose-built SICAR for pure risk capital focus.
Right.
Then the fast-track RAIF, regulated via the manager.
Just speed option.
And finally, the super flexible, tax-transparent partnerships, the SCS and SCSp.
It's quite a toolkit.
So what's the overall message? Where is this heading?
Well, the clear expectation from the sources is continued growth. Luxembourg's PE and VC scene isn't expected to stand still.
And that growth comes from
that ongoing responsiveness we talked about.
Yeah.
The expectation is they'll keep tweaking, keep modifying these structures to meet whatever new regulations come down the pike and whatever investors are demanding next. They treat your legal framework like a product that needs constant updates.
A system designed for evolution. Okay, so given everything we've discussed, Luxembourg's proven knack for creating these tailored modern structures, from the heavily regulated CEF to the speedy RAIF and the tax-efficient SCSp, here's something for you, the listener, to think about. How does this relentless pressure for regulatory innovation, this race for flexibility and speed, potentially change where global capital decides to pool next? If structures like the RAIF show that speed can coexist with robust oversight, just shifted to the manager, how quickly do other financial centers need to adapt their toolkits to compete?
That's the multi-billion-dollar question, isn't it? The jurisdiction that best threads that needle speed, compliance, flexibility without sacrificing investor protection, that's likely where the most sophisticated capital will flow.
Definitely food for thought. We hope this deep dive into Luxembourg's VC architecture has been useful. Thanks for joining us.
Thank you.
We'll catch you on the next deep dive.